Hey everyone, my name is Abdel Misa. Thank you for joining me. I have gotten tons of questions recently about the housing market. Abdel, should I buy a house given the low interest rate environment? Obviously, buying a house is one of the biggest investment in one's lifetime, and there is also a sentimental value to it. So this is an important subject. I happen to have a lot of experience in the area because I have traded home builder stocks in the financial crisis. I also personally have made several real estate investment deals. And finally, as a finance professor, my team 2 years ago won the state championship covering the home builder stock Lennar. So just because of the amount of content, I have decided to create a video series on housing and interest rates. So make sure you catch them all because it's going to be some really good stuff. But before we get started, I know we are dealing with a low interest rate environment, right? But I certainly don't want to deal with a low number of likes. So can you make sure to press those like buttons and the subscribe buttons? Thank you. So let's get going to work. So in this first video, we are going to cover interest rates, but because this is the hot topic right now, interest rates are considered to be low. And so we are going to dive deeper into interest rate. There is a part that's going to be educational, just to cover the basics so that everybody understands what we are talking about. And then we're gonna go deeper into interest rates by covering their impact on prices of houses, why interest rates move in the first place, and finally we are going to address are mortgage rates really low when you compare them versus the treasury rates, which is what the government uses to borrow. So even though they look low right now, they might not be low as people think. Let's now dive deeper into interest rates, and we are going to start briefly with some basics, okay? So let's assume you borrow $200,000 at a 4% rate on an annual basis, okay? So if you borrow $200,000, the interest for every year is $8,000, 4% of $200,000, okay? Now, let's pretend you borrow $200,000, but in year one, you have some extra cash. And then so you pay the 8,000 interest, okay? So that's the interest part. You're paying the bank for the right to borrow that money. But in addition, you pay an additional $50,000, which then will lead you to a principal left of only $150,000, okay? So then when you calculate the interest the following year, it's not anymore $8,000 because the interest now you only owe $150,000. And then so 4% of 150 is $6,000. And then it goes, again and again, you're borrowing 150 and you could potentially pay part of the principal again. Now, I use this example to highlight what everybody is used to. In the case of mortgages, however, it's a little bit different. So let's look at this example. Let's pretend you buy a house for $250,000. And then you use a down payment of 20%, which is $50,000. And then you borrow the rest, the 80%. Okay, so you borrow $200,000 from a bank. Okay, so you take a 30-year mortgage loan with a fixed rate of 3%. Okay, so now this comes out to a monthly payment of $843. How do we get to this monthly payment? There is a mathematic formula, okay? So that's the bank puts it into the computer, and then there is a mathematic formula to give you the exact monthly payment so that by the end of the 30 years, you don't own nothing. If you use Excel, there is a formula called PMT, okay? So you use PMT in Excel and then it gives you exactly the same thing. So here is how it works, okay? So you start with a loan of $200,000. In month one, you pay $843. part of that $843, part of it is interest rate and part of it is principal. So it's always a combination of the two. How much interest rates do you owe in the first month? You owe $500. How do I get $500? Well, I owe $200,000 and the interest rate is 3%, okay? So that means the interest rate on a monthly basis is 3% divided by 12. So if you multiply 3% divided by 12 times the $200,000, you get to $500. But you didn't just pay $500. If you had just paid $500, you will still owe $200,000. We paid more, okay? So we paid $343 more in principal, and therefore the balance, which is the amount that we owe, is not anymore $200,000. It's $200,000 minus the $343 that we paid in principal. So in month 2, we again do the same thing. We pay, again, $843. That stays the same across the loan. But in this case, the interest rate is not anymore $500, it's only $499, okay? And then, therefore, the principal that we paid is not 343, it's 344. And then, so we keep going until, obviously, we have 360 months because the loan is 30 years, okay? And then, so by the last month, the month 360, guess what? The principal, the balance left is 0, and then we're done with the loan. So the math comes out to, at the end, okay, no more balance due. We paid off the entire loan. Now, notice something that's really interesting. Initially in the loan, most of the payments goes to interests, okay, right? But later on the loan, okay, most of the payments are principal. There is not much interest left. Now that we understand the mechanics of mortgages, let's evaluate how changes in interest rates impact both monthly payment as well as house prices. Let's stick with our example with a house that's worth $250,000. We pay 20% down payment and then we take a loan for 30 years, okay, for $200,000. So check this out. These are the monthly payments based on each interest rate. So at 4%, okay, so we have $954. At 3% interest rate, it's less, $843. And then we keep going. At 0% interest rate, it's only $555. So you see that monthly payment in mortgages are highly sensitive to interest rates, and that's why it's really important when interest rates are low, it's very attractive to buy houses. Now let me ask you this question, because as interest rates go lower, yes, it becomes more attractive to buy houses, but the sellers, you know, they're smart as well. They know that you can afford more, so therefore they ask for higher prices. So let's understand that dynamic, okay? So interest rates recently, mortgage rates have gone down from 4% to about 3% for a 30-year fixed rate. At 4%, the monthly payment is $954 for a $200,000 loan. At 3%, it's $843. But let me ask you this. So position yourself as a seller and let's ask ourselves this question. At what loan amount would the monthly payment at 3% be exactly the same as if you borrowed $200,000 at 4%? Okay? And the answer is right here. Okay? So you're basically, it's going to be $226,000. So if you borrow $226,000 at 3%, the monthly payment will be $954. And so the sellers are smart because they know that if you were able to pay $954 before, you can actually take a loan of $226 and nothing will change, and therefore they will increase their prices. And so then it's somewhere in the middle, okay? The sellers will want $226 because like nothing changed for you, but then of course you're trying to get a lower price, and then so the truth is somewhere between the $200,000 and $226,000. Obviously you need to add the $50,000 down payment. Let's now analyze mortgage rates from a market perspective and then look at the situation we are dealing with right now. So we are looking at very low interest rates, and when I talk here about interest rates, I speak about the interest rates that the government pays to borrow. So for example, if you look at the 10-year, meaning how much does the government pays as an interest to borrow money for 10 years, it's around 0.7%. And that has been going down since the 1980s. 0.7% for 10 years, it's really low. So you might ask, Abdel, what's going on? Why are interest rates so low compared to the past? There are three reasons in my opinion. Number one, the economic situation we're dealing with. Obviously, with the COVID-19 crisis, we have to stimulate the economy, and one way to stimulate the economy is to lower interest rates. The second reason is we have been dealing with low inflation rates, and I think the Federal Reserve has done a great job maintaining a relatively low inflation, not too low, not too high. Their target is 2%. And because inflation rates are low, and there are multiple reasons to it, such as globalization, such as automation. I think like with the increase in technology, nobody wants to go to their companies and their bosses and be like, hey, I want a raise, because you might be replaced by a robot or by something that can automate your job. So that's one of the reasons why inflation is also low. And then the third reason, and to me this is even the most important, is what central banks are doing around the world. If you look here in the US, the Federal Reserve has printed trillions of dollars, and they are buying basically these bonds, okay, which results into lowering interest rates. And so the Federal Reserve itself basically causes interest rates to go lower, and they're looking right now to do it across the curve, meaning not just for short term or 1 year or 5 year, but then try to do it over longer periods of times as well. Let's now focus on mortgage rates. That means when you go and then you try to borrow to buy a house, how much do you pay? And let's focus on the 30-year, meaning you borrow for a fixed rate for 30 years, okay? The benchmark that is used for the 30-year mortgage rate is actually the 10-year US Treasury, okay? So when we compare the 30-year mortgage, it's, I'll explain why. We compare it to how much the government pays to borrow for 10 years. So you're like, Abdel, what's going on here? Why is it 30 years on one side and then you have 10 years on one side? Okay, but think about it this way. When you buy a house, the average holding of the house, meaning the average, period, is about 10 years that people live in the house. Why? Because they do two things, okay? Either they move and they sell the house, okay? Or they might refinance the mortgage, and therefore the average duration of that mortgage is 10 years, okay? And so that's why it doesn't matter if it's a 30-year mortgage, people still compare it versus the 10-year. Now, I did an interesting analysis. I compared the 30-year mortgage rates versus the 10-year government rate, okay? And usually, of course, the 30-year is higher than the 10-year, okay? For multiple reasons. One is, obviously, the US government has a better credit, meaning there is less risk of default. There is also, with mortgages, there is a refinancing option, meaning so people have to get compensated for that. And then the third reason is like you have middlemen. Banks have to make money, so there has to be a spread, something that basically banks make more money, and therefore the 30-year mortgage rate is always higher than the 10-year. And so here is what I found out when I did the analysis of the spread between the two. Historically, since 1998, the average spread, is 1.65%. Okay, so the meaning, for example, if interest rate, the 10-year interest rate is at 5%, then the 10-year on average, the 30-year mortgage rates will be at 6.65%. Okay, now if you apply this difference, this traditional difference of 1.65% to the current 10-year, the mortgage rate should be at 2.3%. Okay, so now watch this. If you look just at mortgage rates, they're right now between 3 and 3.5%. You're like, man, historically versus history, these are cheap. They look really nice. But relative to what the government pays, this spread relative to that, they're not actually as cheap. And if things go back to normal, we might get mortgage rate at 2.3%, 2.3%, assuming the 10-year stays at the same level. So I'm sure you're gonna ask Abdel, like, what's going on? Why is this spread so high right now? And there are a few explanations, but the main one is this. Okay, so because of the COVID-19 situation and what the central bank, the Fed, has had to do, okay, so there was a sudden drop in interest rates, and because of that, then the demand for refinancing, okay, has increased so much that banks have not been able to meet the demand. And because of that, they're still keeping the mortgage rates higher. They're smart, okay? So they want to make more money, even though they can lower the mortgage rates and then still make money, but they're able to make even more by keeping the spread higher because there is so much demand. But I think as time goes by, it's reversion to the mean, and then mortgage rate should be even lower, assuming the interest rate is the same on the treasury side. And so this is really fascinating, and I'm really curious to see what's going to happen in the next few months. So now you know everything that's important relative to interest rates and housing. In the next video, we are going to cover other important topics, such as which metrics would you use to know that housing is cheap or expensive? And the other thing is whether housing can be used as a source of building wealth. So stay tuned and make sure to like and subscribe, and I can't wait to see you next time. Take care.